Good afternoon. I'd like to thank everyone for joining me. I wanted to talk to you and touch base on a few things so that we are all up to speed on some major components of us working with other countries. In addition to all the other reports that I've given you, I would like to talk about exchange rates a little more in detail. Essentially, the definition of an exchange rate is the rate of a country's currency as it relates to other countries' currency. So there's domestic currency and foreign currency, direct and indirect currency. When it comes to direct currency is when one unit of a foreign country's currency is given in units of local currency. Indirect is when one unit of local currency is given in units of foreign currency. So for example, if the local currency is the euro, the direct exchange rate for the dollar for one US dollar would be 0.92819 euro. The indirect rate would be 1 euro is equal to 1.08238 US dollars. So in other words, in a direct quotation, foreign currency is the base currency and domestic currency is the counter currency. In an indirect quotation, domestic currency is the base and foreign currency is the counter currency. Most exchange rates use the US dollar as the base and other currencies as the counter. There are some exceptions though, such as the euro, the Commonwealth currency, and the British pound or the Australian and the New Zealand dollar. Next, we're going to move on to trade barriers. Trade barriers are government imposed restrictions on free international exchange or goods of services. Essentially, these are government policies which place restrictions on international trade. They can either make trade more difficult and expensive or block trade completely. Some examples of trade barriers are tariff barriers, taxes on certain imports. They raise the price of the goods, making the imports less competitive. Quotas are used to place a limit on the number of imports. There are voluntary export restrictions. Now, voluntary export restrictions are almost like a quota, but a country agrees to limit the number of imports. Then there's subsidies. A domestic subsidy from a government can give locals the advantage. It gives locals the advantage because when they do a subsidy, it's cheaper for the locals to buy local. And then there's an embargo. This is a complete ban of imports from a certain country. For example, when the US had an embargo with Cuba, nothing was able to come in from Cuba. And now let's look at tariffs. A tariff is a tax imposed on goods or services. These are used to restrict trade as they increase the price of a service or good. This makes them more expensive to the person who wants that service or good. So if you, again, buy local instead of something that's been imported, it would be cheaper because there are no tariffs on those goods. Now, within the jurisdiction of tariffs, there can be specific tariffs, such as a specific tariff could be saying something like there's a $1,000 fee for any car. And then there is an all votum tariff, and that's based on the value of an item. So if your car is, let's say, $10,000, then 10% of the car's value would be that tariff. Essentially, what these tariffs do is give additional revenue to governments and domestic producers of goods and service at the expense of the consumers and foreign producers that want to purchase them or sell them. They are one of the tools available to help shape trade policies. Essentially, the government creates these tariffs as an incentive to buy domestic products because if the foreign products were cheaper, people would buy those products rather than buy the domestic products. Hopefully, this has given you a little more insight into doing business with foreign countries. Thank you.